for our next talk, we're also going to take an interesting look at our financial system. And as you know, I'm an electrical engineer by training, and I truly think of a system as a system. I've had countless conversations, with Andy Lowe about this. Our current state of our financial system is it's a system with regulations that really were designed for the analog days. And while it's fun to talk about analog tubes and computers, in today's digital age, there's a lot more going on. There's a lot more that can lead to great capabilities and great instabilities, depending on how it's tackled. And who better to really speak about this than Andy? I've had pleasure of working with Andy for generations, I think, from leading back to the first time I saw some great analysis that was done for microstructure, and Andy was his thought leadership was able to make millionaires and billionaires out of other people, and my hats off to that. He's been a leader in analyzing the sources of hedge fund returns, been a leader in the case of looking at liquidity, looking at financial stability, creating new financial products, looking at behavioral economics and taking it to another level by analyzing it from an evolutionary neurobiological perspective. Andy is a great mind, a great resource for MIT, and a great resource for us as this group. So look forward to hearing from him.
Well, I want to start by thanking Armin for that very generous introduction. It's been a wonderful privilege to know him and interact with him over the years. He's been extraordinarily helpful to the finance group in being on our advisory board and various activities. And it's a real pleasure and an honor to be here with all of you and to be a part of such a distinguished program today, including Antoinette, Simon, Christian, and all of the other distinguished practitioners. I don't know how many of you realize this, but it was actually pretty difficult to get a speaking slot on this program because of that. And not surprisingly, we understand that all of you are here because you want to be, unlike many of the students in my classes. So I very much appreciate your coming here. I've also been told that for the first time, we're actually charging for this conference, and not a small sum of money. In fact, I looked at it, and the cost of this event is probably the same as what it costs to go see a Broadway show. The difference is that you can actually get tickets to this show as opposed to Hamilton. So I feel like I ought to be doing some rap or something, I'm not going to throw away my slot. But what I want to talk about today, it may not be as entertaining as a Broadway play, but I think it's going to be timely, particularly when we talk about fintech. I want to talk about some of the unintended consequences of technology and what is at the root cause of it and how better technology may allow us to address it. So in particular, I want to talk about the idea of Moore's law interacting with Murphy's law. Now, I know you all know what Moore's law is, the idea that over the years, we're getting better and better at putting more and more transistors on a chip. So this is Moore's law, very clearly outlined in this graph, where it looks like about every 2 to 3 years, we are doubling the number of chips that fit on a transistor. Now, some of the colleagues in Armin's home department in electrical engineering tell me that we're actually getting to a limit now where, given that electrons are only so small, we are going to be hitting a limit of Moore's law. But so far, it seems like it's been moving along on schedule. Moore's law has an implication for financial technology, not surprisingly. And so there's actually a financial version of Moore's law, which you can capture by looking at trading volume. So here's a graph of the trading volume of exchange-traded derivatives over the course of the last few decades. That's the red line. And if you use a logarithmic scale, you get that blue line, which, when you run a regression through it, tells you that we are doubling our trading capacity and volume on exchanges about every 5 years. So that's the financial version of Moore's law. And not surprisingly, that's related to another exponential law, which is population growth. If you take a look at population over the last 10,000 years, you see that there are like 3 or 4 distinct periods. You've got the Stone Age, the Bronze Age, the Industrial Age, and most recently, just over the last 100 years, I would call that the digital age. Within the last 100 years, we've actually increased our population size from 1.5 billion to over 7 billion people walking the planet, most of whom are born without savings accounts, without jobs, without homes. All of those financial transactions have to be ultimately implemented sometime during their lives, which is one of the reasons why we need financial technology. And like all technologies that have really allowed us to grow virtually unchecked on this planet, those technologies can have unintended consequences. Things like pollution, climate change, or other problems with the environment, and financial crises. So I want to start by talking about Murphy's Law, which says that whatever can go wrong will go wrong, and the technology equivalent, whatever can go wrong will go wrong faster, quicker, and will be much harder to debug. And I'm going to give you some examples of it, but I think all of you are aware of those examples. But just so that we're on the same page, let me run through them. It reminds me of a phrase that was used by William Goldman, the Hollywood screenwriter, when asked, how do you make a blockbuster film? He said, well, you know what? In this industry, nobody knows anything. And I would say that that's true for much of the financial industry where it stands today. Nobody knows anything because the system is so complex that it's really hard to tease apart the origins of some of these problems. And so I want to give you an illustration of that, which is the flash crash, May 6, 2010. This was an event that occurred over a 33-minute interval during the afternoon of May 6th. And basically what happened is that somebody must have tripped over a wire or two, because over the course of that time period, companies like Accenture, which started out trading at about $40 a share, became, for about 7 minutes, a penny stock. And then it went right back to normal as if nothing ever happened. Of course, during that 7-minute interval, lots of stop-loss orders were triggered. People actually engaged in trades, and there was a huge amount of financial dislocation as a result. And so the SEC did an investigation right away, and within a matter of weeks, they produced a report that described what they thought was the ultimate cause. And it was complicated. It was a combination of things called stub quotes and order imbalances and automated trading, so on and so forth. And after a few weeks, the report was teased apart and dissected, and it was clear that they were pointing to the trades of one particular mutual fund complex that supposedly had sold a bunch of S&P E-mini futures that ultimately caused the flash crash to occur. That was the narrative at that time. Now, shortly after that, an academic published a paper that said, you know what, that's not quite right, because if you take a look at the record and you looked at the trades of this financial institution, they were actually buying, not selling futures. So it's kind of hard to argue that they were causing the market to crash. And most recently, we saw that the Justice Department and the CFTC filed charges against a London-based day trader who apparently was trading in the basement of his parents' flat, and they claim that he caused the flash crash. It's been over 5 years since this event has occurred. It happened over a finite period of time, to a finite number of securities, with a finite number of traders. And 5 years later, we still don't know why it happened. We still don't know whether or not we can make sure it doesn't happen again. And not only that, we've had all sorts of other technological glitches since then. For example, Bats did an IPO on its own exchange and somehow botched it. Then there was Facebook's IPO. I'm glad that Brad Peterson's gone, because that NASDAQ, unfortunately, had difficulties with that. We had the night trading error that basically cost them the firm. It was a program that was run supposedly in test mode, but somebody forgot to turn off the test mode switch. We had a flash crash in treasuries. We had a flash crash in currencies. Just last summer, we had a glitch, a computer outage on Bloomberg that canceled a UK debt trade. And just last summer, we had a flash crash in ETFs. All of this happened since May 6, 2010. Now, when people talk about fintech being disruptive, I don't think this is what they had in mind. Why is this happening? Well, ultimately, if you come right down to it, it has to do with human behavior. The fact that we are the Curious George of the animal kingdom. We get ourselves into all sorts of trouble because the technology that we use is so complicated and so powerful that in some cases it's got these unintended consequences. So I want to spend my few minutes talking a bit about the research that we're doing at MIT on human behavior, particularly in the investment world. And I want to start by focusing first on what do investors want, because ultimately that's what drives a lot of these things. So I'm going to do that by asking all of you to tell me what you want, particularly with regard to your retirement assets. I'm going to give you 4 financial assets and show you their cumulative growth over an unspecified period of time for an unspecified set of 4 assets. And if you could only have one of them to invest your retirement wealth, I'd like to know which one it is. And I'm not even going to tell you over what time period they are, because I want you to just to focus on the cumulative growth and the volatility to get a sense of what you find most attractive. So these are the 4 assets. And if you've seen this before in my class, please don't give it away to the rest of the audience. The green asset, not very interesting, not very volatile. It turns $1 into $2 over this unspecified investment period. The red line, more volatility, but better performance. The blue line, even more volatility and higher growth. And the black line somewhere in the middle. So how many of you would prefer the green line? Show of hands. Okay. How about the red line? Anybody? A few more. Okay. The blue line. The prop traders and hedge fund managers just revealed themselves. And how about the black line? Yeah, most everybody else. So let the record show that most of us are attracted to the black line because it's got that right combination of risk and reward. Well, let me tell you what these 4 assets are. The green asset is US Treasury bills. And by the way, the time period is from 1994 to 2008, or 1990 to 2008. And the green line is US Treasury bills, not very risky, but not very much return. The red line, which most of you did not pick, is the S&P 500, which has more return, but more volatility. So the fact that most of you didn't pick it, you ought to start looking into your 401k to make sure that you don't want to rebalance. The blue line is the single stock Pfizer, much riskier, higher return. What about the black line, the most popular choice in this audience? Well, that's the returns to the Fairfield Century Fund, which is the feeder fund to the Bernie Madoff Ponzi scheme. Now you know how Bernie Madoff got as big as he did. You know, we're all attracted to high return, low risk. In other words, high Sharpe ratios. That's human nature. And very often, that's what gets us into trouble. So that's one element of human behavior, the fact that we are focusing on this risk-reward trade-off. What about fear? What are investors afraid of besides Ponzi schemes? Well, they're obviously afraid of loss. And here's a good example. So this is the S&P 500 from 1994 to 2013. And you can see that this looks like one heck of a roller coaster ride for you to be putting your money in. Now, Jeremy Siegel has told us that we should put our money in stocks for the long run. But, that means there's some pretty significant drawdowns in the process. In fact, that up and down really does look like a roller coaster ride. And not surprisingly, that roller coaster ride is very pleasant on the way up. But on the way down, sorry. I read a book on making PowerPoint more effective by building in multimedia. Sorry about that. We turned the volume down. Between fourth quarter of 2008 and first quarter of 2009, your maximum drawdown was over 50%. If you put your retirement money in that, you would have seen half of it evaporate. And of course, most of us who are looking at markets wouldn't sit by passively and allow that to happen. We criticize investors for not being buy and hold long-term investors, but I think it's unrealistic to expect people to sit by and watch their retirement go up in flames without doing anything about it. And it's not that this is such an unusual phenomenon. If you go back just a few years, that was the last you're looking at a minus 44% drawdown. Fear is a very potent motivator. And we need to take that into account in what we do. Now, of course, what keeps people in the markets is greed. That's really driving us to continue thinking about it despite these fears. But it means that these two forces of nature are going to be driving us, and that's an important thing to keep in mind. So one piece of research that my colleagues and I have been working on at MIT is trying to rethink the idea of passive investing and what indexes really mean. Earlier this year, I published a paper in the Journal of Portfolio Management called What is Indexing? And it really starts by pointing out that the traditional way of thinking about an index as a market cap weighted basket of securities, that really came out of the 1970s where it was actually tough to trade. So you want a portfolio that's buy and hold because engaging in rebalancing was expensive and complicated. What if it's the case that trading became faster, cheaper, more accurate, and completely automated, like it is today? If that's the case, then maybe an index doesn't have to be market cap weighted. Maybe an index can be something a bit more general. And if you think about what an index really is supposed to do and redefine an index as something that is a transparent, investable, and totally systematic portfolio, that opens up the world to all sorts of new financial products and services. Now, one idea behind that is to come up with what I call precision indexes, something so highly customized that instead of thinking about things like the S&P 500, the Dow Jones 30, or the Russell 2000, we can actually have the Antoinette Shore 30, or the Dave Schmidtline 500, or the Armin Avanesian's 2000. Indexes that are ideally and completely customized to an individual. It took into account your income, your expenses, your age, your health, your taxes, and even your particular psychological makeup. And imagine if this were totally automated. Now, this might sound like science fiction, but I have news for you. The technology actually exists today to engage in these really smart beta strategies. We have the hardware. We have the telecommunications. All of that is ready to go. What we don't have yet is the software. We don't have the algorithms. And there's a reason for that. So what's missing? Well, what's missing is actually not artificial intelligence. We've got plenty of artificial intelligence. What we need is artificial stupidity. By that I mean we need to understand algorithmically how people actually behave, not how we think they ought to behave. And until we are able to do that, we're not going to be able to develop those kind of algorithms for precision indexes. Now, I think that artificial stupidity is a little bit tough. One of my graduate students came up with that. What we ought to be talking about is artificial humanity. That is, we have to try to model how it is that people actually make financial decisions before we can come up with products that can address them. And so that's the goal, is to try to figure out what those kind of algorithms are. And in our investor behavior project, which has many parts, I'll tell you about 2 or 3 of them, we're trying to incorporate all of these behaviors in a complete and integrated whole. So we know from the psychologists and the behavioral economists that people suffer from loss aversion, overconfidence, anchoring, framing, and all these biases, but those have been studied very, very narrowly in the abstract. How does it all fit together into an intelligent decision maker kind of a framework? So what we'd like to do is to build an actual algorithmic representation of Antoinette or Armin or Dave. We want to understand how they will make decisions in various different contexts. And one way we're doing it is using machine learning algorithms with a very large database that we were able to get from a US brokerage firm. We convinced them to give us about 750,000 household accounts from their customers over the course of a 12-year period. We have their trades, we have their positions, we have their net worth, their demographics, we have all of the information totally anonymized. And what we're trying to capture is not only what they're thinking about, but also how they decide on various kinds of decisions at various different points in time, including situations where when the market goes down, they freak out and decide to move into cash. So let me give you an example of one of the statistics that we've come up with data. We just got it a few weeks ago, so we don't have a lot of results yet, but share with you some preliminary results that we do have. This is a very simple histogram for individual securities over 60-day holding periods of what their net trades are for those securities. So what you'll notice is that there is a very big left bar at minus 100%. What that bar represents is individuals basically closing out a position in a given security. They're actually eliminating their total investment, minus 100% of their investment in that security. And if that security happens to be an S&P 500 mutual fund, basically what they're doing is going to cash. They're freaking out. And so this is an interesting, simple statistic. It says that many people close out individual positions over 60-day periods. Fine, that's not a big deal. But what is particularly interesting is the conditional probability of that kind of closing out. This is a graph that shows what the past 20 days cumulative returns are in that particular security, and then what the conditional probability is of closing out a position of that security given those past 20 days returns. So the horizontal axis gives you that previous 20 days return, and the vertical axis is the probability that you're going to close out the position entirely over the following 60 days. The U-shaped curve, what that tells you is that if you experience a very good return or a very bad return, you are more likely to close out your account than not. Now, that's interesting. That tells you that there's some dependence on how you've done. But what we found even more interesting is that we can actually tell whether or not an investor is more or less likely to do that kind of a closeout based upon one very simple feature, and that is, have they done one or more trades in the last 20 days? So the right-hand graph with that orange curve is that same curve of whether you're likely to close out your position within the next 60 days, but conditioned on having done one or more trades over the last 20 days. Look at the difference between the orange curve and the blue curve. If I know that you did a trade or one or more trades the last 20 days, and you've experienced an extreme return, positive or negative, that gives me a lot of information about whether you're likely to close out your position in that security. So that's a very simple example of using large amounts of data to be able to tell which consumers are likely to freak out or not. And with more sophisticated features that we're detecting, we can actually come up with more refined measures about the particular psychological makeup that will cause an individual to change his or her holdings under extraordinary conditions. So now this brings me to the more speculative part about our research, which is, can we tell more about a person's psychological and emotional condition based upon other characteristics besides what you get in a particular brokerage account survey? And so this goes back to some early research that I did quite a few years ago that's actually gotten some recent interest and relevance because of some new studies that we've done and some new equipment that we've gotten. So back in 2002, a postdoc of mine, Dmitry Repin, and I, we actually measured the physiological characteristics of traders as they were actually trading. Because people said that emotion was important for trading, so you may as well measure their emotions, and you can do that by putting electrodes on their face, their hands, other parts of the body, and wiring them up and measuring their physiology while they're trading. Now, this seems pretty weird, I realize, but if you really want to understand emotion, we figured you may as well go to its very source. We also use psychological surveys in tandem with these physiological measures. And just to show you what those measures looked like back in 2002, it was pretty cumbersome. You actually had to put electrodes and tape them on the faces and the hands and the chests of individuals. And you had to plug in wires that would go into this box that would then plug into a laptop to measure these physiological signals. So here's a picture of an actual live trader with all of this stuff wired up. Here's another picture where you can see the laptop that's right next to him as he trades. And here's a very rare picture of a female trader. There aren't that many back then. There are more now. This is somebody who is a trader, a specialist on the Boston Stock Exchange. And so you can see the various physiological measures as she's trading. So what we're measuring are things like blood pressure, heart rate, and most importantly, skin conductance or galvanic skin response. It turns out that measuring the activity of your sweat glands is actually a pretty good signal of whether or not you're emotionally engaged. It doesn't tell you whether it's positive or negative emotion. It just says that there is strong emotion going on when that measure goes off the charts. And so we measured all of these things together with the markets to see whether or not we could tell whether their emotional faculties were being used in various different settings. And we found something quite remarkable. At first, we thought it was really just an anomaly, but it happened that the idea came about, this was a real phenomenon, when I ran this experiment in my 401 class. In fact, I don't know if any of the students were here today that were in that class, but around 2000 or 2001, I decided to run a trading game in my introductory finance class, and because I was doing this research, I decided to ask a couple of student volunteers to agree to get wired up while we were running this trading game. And after the session, I looked at the physiological characteristics of these two students. I showed them on the screen to the class, and one of the students had physiology that was very similar to the traders that we had been wiring, and I'll show you in a minute what that similarity was. And the other student didn't. So the student that had this similarity, I asked him, well, what did you do before you came to Sloan? And he said, I traded government bonds at Merrill Lynch for 5 years. That really freaked me out. That was really eerie. And what that physiological characteristic was, let me show you. The blue line is skin conductance. And when it's high, it means that there's emotional activity. And when it's low, it means that there isn't. And what's in red in the little crosshatches, the X's, are trades that were being done by the specialist. So you can see that when the trades are happening, the blue line is high, but there's a period where the blue line drops off dramatically, and that's a period where this particular specialist decided not to trade because she thought that volatility was a bit too high. And so she held off. And this is exactly what we saw in the professional traders and in this one student. It's that when they're not trading, the emotional engagement is much lower. Whereas for the typical control sample of people that don't have any trading experience, the emotional movements are all over the map and don't have any strong correlation to trading. It's as if traders use emotion in a very specific way, almost the way a professional athlete might, and can turn it off and on at the appropriate moments. And so what we're doing now is running the same kinds of experiments with traders. We just did one last year where in a trading context, we actually ran a game and measured these physiological signals, and we're getting the same results. But we just discovered a few weeks ago that we can now do the same measurements without all of these wires. We can actually do it with sports watches. Not this kind of a watch, but these kinds of watches. And so we're working on an application now where we think we can hack the code to be able to back out some of these physiological characteristics just from a Fitbit or a Microsoft Band and be able to allow you to see when you're about to freak out in these kinds of conditions. Biofeedback actually plays a pretty important role in being able to manage your own perspectives. And for financial applications, we think that that would be a real opportunity. We're looking for volunteers, so if anybody wants to participate, if you know of a trading desk that would like to wire up their traders, please let us know. We're happy to do that. So let me wrap up by saying that financial technology has really changed everything. And that's really part of a much more general trend in technology. We've seen driverless cars, digital currencies, social media, and so on. But despite the fact that they are making inroads in finance, including robo-advisors, we have to keep in mind that ultimately there is a common denominator, and that is human behavior. Human behavior is at the crux of all of these technologies. It's both the tip of the spear as well as the canary in the coal mine. It's a positive and a negative, and we have to keep that in mind, and we need to develop better technologies to take that into account. It's like the difference between a VCR with that blinking 12 that nobody could figure out. You'd have to read a 40-page volume to sort that out, versus TiVo that makes it simple for individuals to manage their viewing. We need behavioral adaptive technologies so that the next time that your clients start freaking out, it's because they're actually on a real roller coaster ride. Thank you.
Is this on? It's on. Thank you, Andy, for that informative, entertaining, and provocative presentation. Provocative question. Do you think technology is ever going to totally replace human traders and investment advisors?
Well, I think it's going to be a long time in coming if that's the case. I think that humans, for a very long time, will only be comfortable dealing with other humans when it comes to significant life-altering decisions. I don't think that'll change in our lifetimes and probably not in our grandchildren's lifetimes. But what will change, I think, is that technology will allow financial advisors to greatly leverage their ability to interact with clients. So let me give you a quick example. Just in using the technology that I just described, those of you who are financial advisors, I don't know how many people you have in terms of your portfolio of clients, but imagine a technology that would allow you to predict which of your clients are most likely to freak out when the S&P drops by 15% or more. And then you could focus your abilities on helping them manage through these periods. Well, that would allow you to manage a much larger portfolio of clients. So that's an example where technology will help you do your job better, but will it replace you? No, not anytime soon. We all want to deal with a human face when push comes to shove. And by the way, all of the robo-advising firms that are out there, I've heard reports that over the last 3 or 4 months, they were inundated with phone calls because in the face of losses, people actually want to talk to a human being about what they should be doing next. So robo-advisors are good in certain circumstances, but at some point, humans are going to need to be involved.
Thank you for a very informative talk. To what degree do you think, or are you seeing a backlash to the use of this type of technology, whether it's in the financial sector, and to what degree are you getting interest from other sectors in using this sort of emotional surveillance technology? Well,
so backlash is probably too strong a word because that would mean that there would have to be a lash. And so I'm not sure that there's a lash yet. In other sectors, in other industries, this is commonplace. For example, in the field of marketing, consumer surveys, psychophysiological methods are used all the time. In law enforcement, we know that lie detector tests, which is really the basis of this technology, they're used all the time. So I think finance is a little bit slow to the table, and partly because I think there's a lot at stake. There's also privacy issues. For example, imagine a trading floor where all of the traders were wired up and you actually had these wristwatches that could monitor their physiology. I mean, that is a significant invasion of their privacy because if they're going through a divorce, if they're engaging in certain kinds of medical treatments, you might actually be able to see that on their watches. So I think that there are some issues that we have to address, and maybe cryptography using secure multi-party computation methods will allow us to share information in ways that could preserve privacy as well. So this is definitely a brave new world, and it's going to take a while for us to be able to get to the point where it becomes standard. But I think the research has to come first. So our approach is to first show that these methods are useful. We've already seen in relatively narrow contexts they are. Can you use them to screen traders? Can you use them to find problem traders? Those are questions that we don't know the answers to yet, but we're hoping to do that over the course of the next few years.
This is going to be the last question, Andrew, over here to your left.
Yeah.
Test. So you talk about the creation of new indices and in trying to incorporate human behaviors into these indices, but isn't a lot of the research, a lot of what financial advisors try to do is try to take the human emotion out from investing and trying to make the decisions not based on emotion. Don't sell after you've lost already 50%, especially if you're diversified.
Right.
Basically because of what you see afterwards.
Yeah.
Wouldn't that be counterproductive to the theory of investing?
It would be counter to the theory of investing, but I would argue it would not be counterproductive to the theory of investing. You're absolutely right that the way that the investment management field has gone is more standardization, one size fits all. They've tried to do some product differentiation. We now have smart beta products. We have all sorts of different large cap, small cap, value growth, and so on. But by and large, those products have really been tailored to very, very broad kinds of investment mandates. And what we're seeing from the investor's perspective is that's just not appropriate because one size doesn't fit all, and particularly it has to do with emotion. So you mentioned taking emotion out of it. I would argue that we need to put emotion back into it, if only because it's impossible to expect humans to take emotion out of their day-to-day decision making. And as long as humans are involved in the decision, you're going to have to deal with it. So why not deal with it in a way that's going to be productive? You know, it's a little bit like having a teenager in your household, which I do. You can tell teenagers to abstain from sex and not get pregnant early. And abstinence is probably good advice, but is it realistic? Do you really think that you can stop teenagers? A better approach would be to educate them and to provide means for them to manage their behavioral tendencies in a more productive manner. And so I think that this notion of precision index is, let's agree that we all freak out from time to time. Freaking out is not necessarily a bad thing. It's when we don't get back into the markets after 3 or 4 years that really does the damage to wealth accumulation. So being able to take that emotional response into account, recognizing and honoring it, dealing with it, and then being able to figure out ways of getting around it, that's going to be the most advanced kind of financial product. Thank you very much.